Thanks for joining me here at NTD Business. It seems like business rivalry between two of the tech industry's most powerful billionaires isn't enough. Now, tech billionaires Elon Musk and Mark Zuckerberg has agreed to go up against each other in a cage fight challenge. This is after a series of posts on social media platforms on Wednesday. Tesla CEO Elon Musk posted a tweet on his social media platform Twitter saying he was up for a cage fight with Mark Zuckerberg. Meta CEO Zuckerberg then posted a screenshot of Musk's tweet on his Instagram stories with the caption reading, "Send me location." Musk then posted another tweet with Vegas Octagon. Now, the Octagon is where Ultimate Fighting Championship or UFC competitions take place in Las Vegas, Nevada. Musk, 52 years old, joked in another tweet, "I have this great move that I call the walrus, where I just lay on top of my opponent and do nothing." He also tweeted, "I almost never work out, except for picking up my kids, throwing them in the air." A Meta spokesperson told the technology news website The Verge that Zuckerberg's post was not a joke and that the story speaks for itself. Meanwhile, 39-year-old Zuckerberg has already been training in mixed martial arts and has recently won jiu-jitsu tournaments. Zuckerberg is around 5'8" and Musk is 6'2". Who do you think is going to win? And Federal Reserve Chair Jerome Powell finished his second day of testimony on Capitol Hill. Here are some takeaways from Powell's testimony to lawmakers. First, he's hawkish on inflation, but the pace of hikes is moderating. Powell told lawmakers it was a pretty good guess that the central bank would hike rates twice more this year. Powell also addressed the recent turbulence in the banking sector, stressing the importance of ensuring that we have the appropriate rules and supervisory practices. Republican committee members spent time Wednesday questioning Powell about the central bank's stance on bank regulation. In question was to whether to raise capital requirements or how much cash a bank must hold. Some Republicans argue that requiring banks to hold more funds in reserves would restrict their ability to lend. Small businesses, they warned, would be especially hurt because they depend more on bank loans than do larger companies, which can issue their own bonds. Reduced lending, they asserted, would weaken the economy. Powell responded that any such new rules would likely focus on the largest U.S. banks, those with more than $100 million in assets, like Silicon Valley Bank and the other two institutions that failed. The Fed chair also said it could be several years before such rules will take effect. At the same time, he underscored that there is always a trade-off between requiring banks to hold certain levels of funds in reserve and encouraging lending. The challenge, he said, is to strike the right balance. And the stock market is soaring for the most of this year, and a lot of the gains are because of the excitement surrounding artificial intelligence. Nvidia stock is up more than 200% this year. Things have run up very quickly, maybe too quickly for some. Many investors are comparing what's happening now to the dot-com bubble of the early 2000s. But is it really a bubble this time around? To talk to me about this, here with me is Lance Roberts, Chief Investment Strategist at RIA Advisors. So, I think this AI hype really started around the time ChatGPT was released, and since then things have run up quickly. I mean, right now, companies just mentioning the word AI in their earnings calls are getting a boost. I mean, Heinz, the ketchup maker, talking about AI. So, you're seeing all this, the mania around AI, if you will. What's going through your head?
Well, first of all, we got to put this in perspective, right? AI has been around now for almost a decade. This has been something we've been talking about for a while. Artificial intelligence, robotics, all this. So a lot of this, we've already known about. ChatGPT is an example. It just really kind of kicked. All of a sudden, it just became mainstream, and everybody's going, "Oh my gosh, AI's here." And now we've got ChatGPT, and if you go on TikTok, it's just one video after another of how to make $1 million with ChatGPT. But the problem is ChatGPT is very flawed. It's if you have bad information going in, you're gonna get bad information coming out. It's also free, right? So if I want to use ChatGPT or if I use Google as an example, what's the revenue multiplier of that, right? Before, Google, as an example, would provide you a lot of links that were paid for by other companies to get to the top of the search engine, and that's how Google made their money. Now, ChatGPT just gives you the answers, so I don't need to go click on these other links. So we've got to start talking about ultimately, how do we monetize this? How do we make more money for these companies? Because we have to justify the earnings, right? And so when you take a look at valuations of companies, we have to go back and look at who can afford to do this and what's the monetary proposition. This is very similar to what we saw back in 1999 with .com. Everybody wanted to jump on the website, put up a web page. It was all about eyeballs per page. But the problem is the revenue never came as expected, and earnings and prices were well estimated above what reality turned out to be. That's the thing we have to figure out with AI.
So would you define this as a bubble?
Well, we're definitely getting into the mania phase, right? Bubbles you never know about until after the fact. So, if I sit there and go, yeah, this is a bubble today. Well, bubbles can go a lot further, right? And if you take a look at what the market's doing today as compared to 1999, we haven't got to the bubble mania phase yet. That's still potentially to come. And so that's hard to imagine, but in the late 1999 year, starting in about October, the Nasdaq just went parabolic. And for about 3 months, there was no stopping stocks from going up. Of course, in March of the next year, it all ended very quickly. So calling things a bubble is dangerous because we never know where we are. But are things getting a bit ahead of themselves? Absolutely. And there's a function of what this is going to mean for earnings and valuations down the road.
Since we're comparing this to the .com bubble, I mean, let's talk about the setup. Is there any similarity, any differences? Can you talk a little bit about that?
Well, as being one that, I'm older than you, right? So I lived through the .com bubble. I grew up in an age where there were no cell phones and there was no internet, right? We had to look stuff up in books. I know that's an ancient concept now, but that's the way it was. So this whole idea at that time was the internet was going to make our lives so much better, so much more productive, and it did, right? The internet changed the world as we know it. The problem, as I said before, is that the revenue didn't come because what happens when you get everybody focused on one thing and all of a sudden everybody starts seeing the riches of the .com bubble? It brought in a lot of competition that brought down prices. Competition breeds a discount in prices. And this is what we're looking at today. Today, there is a difference. Companies actually make money that are involved in AI as opposed to .com companies back in 1999. So there is cash flow this time around. But to think about, if I want to start AI, it's going to cost me $250,000 per GPU from Nvidia. If I need a controller card, et cetera, we're talking about $190,000 for controller bases. These are very, very big capital-intensive projects that a lot of companies don't have the ability to contribute $500 million to building out AI. So this is going to be relegated a lot to large companies right now, but competition, as other companies see what Nvidia is doing, and AMD just announced this, AMD just came out with their own GPU. Well, as you have more companies come into market, that's going to bring down the prices of GPUs, bring down the cost of entry. This is going to bring down profit margins. Think about this, right? We have a recent comparison. Think about the cloud computing space. Everybody was going to store everything up in the cloud. And so initially, the profit margins on cloud storage, revenue was very large. But now that Amazon and Apple and Microsoft and everybody has gotten into the cloud space, the profitability of the cloud space is being compressed because profit margins are having to come down for competition, right? So a lot of these estimates about future earnings growth are way overextended as to what reality is ultimately going to be because of increased competition in the space. So you've got to be careful. Nvidia trades at 40 times price to sales. That is unsustainable, period. You cannot maintain that type of valuation in Nvidia. So either sales are going to grow exponentially or the price has to correct. And that's the same for a lot of these stocks in that space.
So, Nvidia, very overbought, 40 times price to sales, as you mentioned. I mean, you're a portfolio manager. You're seeing all this. It could go on for longer. I mean, what do you do, Lance?
Well, so, this is where you've got to make some decisions, right? As an investor, you have a choice. You can speculate or you can invest. If you are investing, which is a long-term horizon, you don't want to buy companies that are trading at 10, 20, 30 times price to sales or grossly overvalued valuations, because your long-term holding period for those stocks are going to be very low in terms of return. But if you're speculating in the market, look, if you're a day trader or your investing horizon is 3 months or 6 months, or if you're just trying to throw money at the market to make money, then yeah, chase momentum, because this is a momentum market right now. Stocks are going up. The bear market is likely behind us. The lows in October are probably in. And so for now, use opportunities on pullbacks in some of these stocks as an opportunity to buy positions, but make sure that you manage risk, right? Maintain stop losses, take profits along the way, because eventually at some point when the market realizes these earnings can't be justified, the prices will correct a lot. So just understand that there is risk to buying these stocks. It doesn't mean you can't make money short term, but long term, there is certainly risk to valuations.
So this AI hype, I do think that you believe there's only a couple of ways that this is going to end. I mean, what do you think are those scenarios?
Well, look, is AI going to make the world a more productive and efficient place? Probably, right? I mean, artificial intelligence is going to make our jobs a lot easier. There's also a dark side to this, right? It's going to replace a lot of jobs. Artificial intelligence can do your job, right? We've already seen deep fakes that are coming out. I get your image, I write the text, and artificial intelligence voices it for you. You mouth the piece, and you're off on a beach somewhere, right? But, so there's going to be a problem ultimately with the jobs it replaces, because now artificial intelligence can do all the jobs that before we didn't think were replaceable: accounting, legal, finance. My job as a portfolio manager, artificial intelligence can do that job. So, this is going to be, kind of the dark side of this, that, does it enhance productivity? Does it make our lives better? Or does it start replacing jobs, bringing down wages, bringing down living standards, because rather than paying the high cost of wages, I can pay an expensive AI up front and then reap that benefit of lower wage costs over time. That's going to be the thing we have to figure out. And then, of course, there's also the same problem we have with social media, is the dark side of what happens with AI in terms of the society in general, right? And this is what you call surveillance capitalism. Social media, the dark side of social media is that it uses surveillance capitalism to see what you do, what you look at, and then to make recommendations on what you should buy. And so you're influenced to make these purchase decisions through surveillance. AI can take that to a whole new level. So we should, as consumers, we need to be aware of that.
To your point that AI could potentially replace my job, funny story. One of our reporters asked AI to generate an image of me like 10 years from now. It looks nothing like me, but it looks like a complete different person.
Yeah, hopefully you aged well.
No, it's not that. It looks like a different person.
Yeah. Well, and again, this is for as journalists, right? ChatGPT can write articles, they can write blog posts, they can write news articles. So what's the job of a reporter going to be in the future? That's going to be this is going to be the challenge that we face. How do we establish our relevance, right? And so when we talk about capitalism, and you and I have had this conversation before. Capitalism is the value of what we bring to the table, what we can generate in terms of respectable, payable value. We've got to bring something now to the table that AI can't do, that human touch, right? That human interaction, that logical approach, because all AI does is regurgitate the information it has. Originality is going to be the thing that we have to bring to the table. And this is going to be something we have to really focus on as individuals.
The fact that companies just mentioned the word AI in their earnings call and they get a boost. I mean, what do you think is driving this hype, this AI hype?
Well, just that. I mean, look, we saw this back in late 1999, right? As with the dot-com boom, companies would come out and they had no relationship to the internet at all. They just came out and said, "Oh yeah, we're changing our name from industrial parts to industrialparts.com," and they put up a web page, and the stock would go through the roof. And it's just because of that speculative nature of the market. This is just, we saw this with meme stocks back in 2020. We saw it with IPOs and SPACs. It's whenever there's a new shiny toy in the markets and that retail investors can chase, now it's AI. Everybody's looking at Nvidia. Well, I missed the move in Nvidia. So any other company that announces AI, I'm going to try to buy it now before it goes running off to the moon like Nvidia. And it's that fear of missing out that we're seeing in the markets. It's just part of that psychological hype that happens during a bull market, and that's definitely where we are right now.
Speaking of fear of missing out, is right now a good time to invest in Nvidia?
No. Well, and what I'm saying is no at the moment. It's just very overbought, very extended. It's up 160% this year. So, you're going to get a correction in these stocks. Now, that doesn't mean they're going to fall 50%. I'm not saying that at all. But you do need to see these stocks pull back towards their 50 or their 200-day moving average. And that's going to give you a much better risk-reward basis to enter that stock than trying to buy it now.
I think Nvidia, the last time I checked, moved a bit closer to the 50-day moving average, did it not?
It did, and then it ran back up to new highs. So it didn't quite get there. But again, it's very extended from its long-term means. It's very extended from its 200-day moving average. And moving averages act like gravity. So the further the price gets away from those moving averages, the more gravitational pull there is to pull it back. So just be patient. If you want to make an entry into the stock, be patient. You may wind up buying the stock right where it is today, but after a correction where the risk-reward entry point is a lot better than trying to buy it here today.
Can you explain that a little bit? Because even though you're buying at a higher price, the risk-reward is better. But if you buy it now, you can get it at a lower price.
Well, you could, but you could buy it today as an example. And it's very overvalued, very stretched. And then the stock could correct, 5, 10, 15% very easily. This stock is so extended right now. A 5 to 10 to 15 to 20% correction would just be within the normal uptrend. But the problem as an investor is that you're going to psychologically, oh my gosh, I'm losing 15% of my money. I better sell it because it may go lower. Then you're out of the position. But at that point, the stock is now oversold. It is now on support. It's now on a risk-reward basis. It has less downside and more upside potential. So again, by waiting and by letting the market kind of come back to you, it gives you both a psychological entry point to where you're able to withstand a bit more correction if it occurs, or you have the potential to make some gains in the short term as that stock rebounds and tries to move back towards its previous highs.
All right, thank you so much today, Lance. Always a pleasure speaking to you.
My pleasure. Thank you so much.